I'm joined today by Michael Kitces, who's a partner and director of research at Pinnacle Advisory Group, a private wealth management firm located in Columbia, Maryland in the United States, and they oversee more than $1 billion in client assets. Michael's the publisher of the financial planning industry blog Nerd's Eye View through his website kitces.com, and you can see those details on the screen once he starts talking. He's also a regular speaker at industry conferences throughout the United States and also in Australia. He's authored a couple of books and he regularly appears in Wall Street Journal, Business Week, to name a few, but many other publications as well. Thanks for joining me, Michael.
My pleasure. Great to be here. Thanks, Dave.
I just wanted to get an insight with you, Michael, in terms of what's happening in the United States at the moment in the financial planning space, because I think there's probably a lot of things that in Australia we can take from that, some of the same issues that we're dealing with as well. The first thing I wanted to ask you about was longevity risk in retirement planning. In Australia at the moment, we've got an aging population, and one of the issues with medical advancements, for example, is people living a lot longer and still retiring around the same age, around 60 to 65, but living a lot longer and needing their assets to last much longer than they used to. What sort of things are you seeing that affect in terms of diversification of investments, or what decisions people are making?
So we're seeing a few things that are kind of coming forth out of the kind of the longevity wave, and we have a version here in the U.S. as you do there as well, what we call our baby boomers, sort of this large demographic cohort that was all born shortly after World War II, that is now this sort of giant age wave group that's been moving through, and now they're all on the cusp of retirement and transitioning in. So we're actually seeing a huge kind of industry shift in the direction of really focusing on retirement planning, longevity risk, and those kinds of issues here in the U.S. marketplace for financial planning. Now, when we look at how it's getting handled, we're seeing a couple of different sort of threads and approaches come forth. So one is to say, look, it's generally a difficult thing to take ongoing withdrawals for an extended period of time from a portfolio that has volatility and moves up and down. We know maybe over the long run, or at least we believe over the long run, that we're going to get a reasonable rate of return. But once cash flows are coming out of a portfolio, it's not enough just to get a reasonable average and pick some conservative time period and sort of amortize your wealth down. You get some volatility along the way. You get a bad decade. You've depleted so much. There's not enough money there to get you to the end, and suddenly you have a problem. So, the easiest way to sort of solve that is to say, well, I'm just going to take such a tiny amount from the portfolio that even if I have a horrible sequence, I'll be okay. So, sort of in the logical extreme, if I have $1 million and I only take out $10 a year, it doesn't really matter what happens to the returns. I'm not going to run out of money in 30 or 40 years. Now, obviously, taking 0.01% is too little. Taking 8, 9, 10% is too high. So you try to refine it down to something in the middle. And we've had this body of research called safe withdrawal rate research over the past 20 years that's tried to refine that number down. And what we find here in the U.S. markets is that number that works. So how low does your spending have to be so that even if you retire in the worst period in the history of the U.S., your spending would have been low enough to survive it? We find that magic number is about 4% of the starting account balance, and then we adjust it each year for inflation, and that's lasted any 30-year period we've ever had in U.S. history. So we've seen that sort of one approach that's come forth out of the U.S. It's often called the safe withdrawal rate approach. Some people just call it the 4% rule because that was kind of the magic number that came out of it. And there have been a lot of refinements since then of different ways to adjust and manage it. But that's sort of the initial approach. That's kind of portfolio-based, portfolio-centric approach. Still have to invest well diversified, still have to invest with some level of growth. So we see things like 40 to 60% in equities because we need enough equities to get some growth in the long run, but not so much that we can't handle the volatility in the short term, and we kind of end out in the middle.
Yeah, okay.
The next approach that we see coming forth are various forms of retirement income guarantees. So that might be annuitization, which is sort of our version of superannuation products in your country, where we actually convert a lump sum into a lifetime stream of income and then draw on that income for life. And by virtue of the guarantee of the annuity company, those payments will last for life and you can't outlive them. That version is, I think, been a little bit more controversial. You sort of look at the research, and obviously, if you don't want to outlive your money, turning it into a lifetime stream of income would seem to be a pretty darn straightforward way to make sure you don't have this problem. But when we look in practice, an incredibly tiny number of Americans ever actually annuitize. So when we look at the industry statistics, it's something like 1 to 2% of people who ever buy an annuity product actually convert it into a lifetime stream of income. And everybody else in the U.S. ends out, we actually have some tax benefits for annuities that you accumulate with before you turn them into lifetime income. But we find almost everybody just keeps them in the accumulation phase and then just uses them as another bucket to take withdrawals from, and they never got around to the actual lifetime income. We had a wave of companies over the past 10 to 15 years that said, well, gee, if that's what people want, we'll just give you guarantees on your withdrawals rather than forcing you to convert into a lifetime stream of income. Unfortunately, a lot of those companies decided now that maybe they offered a little bit too much of a guarantee for the amount of the financial crisis, and many of the companies have left that marketplace completely since 2008 and GFC, and most of the rest that are still doing it now have guarantees that are drastically more expensive and less favorable than the ones were before, almost to the point now where you would look and say, you know what, maybe I'll just do the spend conservatively and manage my costs approach, because the higher guarantees thing isn't actually really giving me much more than just being conservative and low cost in the first place. So that's kind of the duality that we see is, a lot of interest in annuities and lifetime income products, but still fairly limited adoption, and sort of this growing base of research. This is all right, if we're not going to do that, what's a reasonable withdrawal rate from that portfolio? How should we prudently invest it? And how do we manage that on an ongoing basis? And, frankly, I think our industry bias here, as really around a lot of the country, around a lot of the world, so many of us are implementing this business by charging on assets under management as a portion or all of our revenue that, frankly, we have a little bit of self-interest to see it execute that way as well. Now, even when you look in some areas that don't do it that way, the lifetime income use often isn't much higher. So I don't think it's purely like the industry is talking people out of lifetime income products, but it certainly doesn't help. And I'm sure there are a lot of businesses that don't mind that we continue to use these portfolio-based approaches.
Yeah, okay. Yeah, look, I think it's an interesting point you make around the take-up of that, because we've seen a similar trend here that post-GFC there was a lot more products around that were, annuities did come back into favour to some degree, certainly the marketing of them, or capital guaranteed type products as well. But my feel has been similar, that the take-up has not been so much, and in particular, I guess it's influenced a little bit by other market returns as well. If equities are starting to perform a little bit better again and you see a bit of recovery, then the take-up of annuity style products doesn't come through.
And I think we still just see this challenge at the end of the day. It's nice to talk about retirement income and how afraid clients are of running out of money and outliving their money, but then most of these products, ironically, the ones that are priced the best, you give up all of your liquidity in exchange to get this lifetime income. Like, truly, that's what makes the math of the mortality credits work out most in your favor. But then we get down to that point, and consumers look at that and they say, oh, well, if I turn my lump sum of money into a stream of income, the good news is I won't outlive it. The bad news is, like, now I feel poor now because I don't have an account balance anymore, and we sort of have this irrational preference for liquidity. And so, to me, that's sort of the challenge to it. We can say we're afraid of outliving income, but then when we look at what else we're afraid of, it turns out we're also really afraid of just not feeling liquid and wealthy, and that still drives a whole lot of decisions too. Yeah. Sometimes bad, but it is what it is.
Yeah, absolutely. I think that leads into my next question, which is around generating income returns from a portfolio. It's interesting that in Australia at the moment we're talking a lot with clients around what they're doing with their cash at the moment. again, post GFC, we saw a lot of people, particularly retirees or pre-retirees, moving out of equity or equity type investments to hold larger amounts of cash because they were moving to that safety. Now interest rates have come down. Deposits with banking institutions have come down from as high as 7-8% 4 or 5 years ago to gradually come down to current rates of just under 4%. Now, for investors in Australia who have got cash, that feels like it's a really low income return compared to what they've been used to. And the challenge is now looking at what alternatives are around to try and boost that income level up a bit. Interested in your take on that. Obviously, you guys have been dealing with far lower interest rates for a longer period of time.
Yeah, I mean, it's funny, and I was struck by this when I was in Australia last year and the year before. I was there for your Portfolio Construction Forum conference in Sydney and talking to advisors there who were kind of lamenting the same thing. That was a year or two ago. Your rates were still a little bit higher, but they had been winding down. And, people were concerned that, they were only getting, I forget what the numbers were at the time, 5.5 and then 5 and then 4.5 and then 4 on things like 1-year term deposits. And, we're sitting here in the U.S. going, I can't get half a point on a 1-year term deposit from many banks. Most money market funds, all they give you is 0. I mean, the good news is they figure out how to generate enough return that the fees from the money market won't be negative. That's the best they're struggling to do, and that's a struggle for a lot of companies here in the U.S. right now and banks in the U.S. just to figure out how to keep savings even and not have it be negative return from any level of costs and fees because there's just no return. I think that's really had a lot of impact to investors here. I think we actually sort of understate in a lot of ways how that's impacted investor behavior here. I think it's driven, frankly, a lot of investors into our equity markets because they're just looking and saying, anything's better than 0. It's driven some people out to the longer end of the yield curve, which frankly is a little bit concerning because in the near term you get a little bit more yield. In the long term, we all know how this plays out. At some point the rates go up again, and then a whole lot of people lose a whole lot of money from the interest rate risk in the rising rate environment. It spurred a lot of interest in, broadly speaking, the label that we use for alternative investments, which here in the U.S. context at least, alternatives basically means anything that's not stocks and bonds. So some advisors will include commodities and gold, some will include real estate, some will include sort of different investment vehicles, hedge funds, managed futures funds, just different ways to invest in markets. We've seen a lot of interest in those kinds of either sort of alternative strategies or just alternative asset classes. Again, just hunting for a way to get yield, return, capture a new risk premium. We've seen rising interest in risk parity as a new way to invest and sort of diversify out by risk premia. And then in general, we've seen sort of this very strange split in investor behavior that the ones that seem to be taking it the hardest over the past 5 years since GFC are basically the traditional active mutual fund, investment fund managers here in the U.S. And consumers have actually done this sort of very strange split. So on the one end, a bunch of them have said, all right, if these active managers aren't going to do much for me anyways because they didn't save me from GFC, I'm just going to save these costs, get rid of all these active manager fees, and I'm going straight out to indexes. And so some of the major index companies here in the U.S. have grown absolutely humongous. Vanguard, certainly the leader, I think is running something like $2 trillion of assets under management now. And I believe they were under $1 trillion in 2008. So just unbelievable explosion in money and dollars and asset flows to indexing. Then we also see investors that have gone the exact opposite extreme, which says, if I'm going to be paying for an active manager, I want someone that really knows how to manage around these kinds of issues. And so we see the growth of tactical asset allocation, generally the growth of sort of global active managers. Sometimes they get called go anywhere managers, managers that can just say, hey, I'm just going to go out there and find what I think is appealing and not own what I think is unappealing. we're not going to worry as much about asset classes and all that other stuff. We're going to look at valuation and maybe some momentum and just try to buy things that we think are appealing and not buy whatever else, and sort of scrap a lot of traditional ways that we do asset allocation. So we've kind of seen this split in either direction. Sort of, you go a whole lot more active or you go a whole lot less active, and most of the industry that was originally in the middle is getting squeezed mercilessly. So advisors that were in the business basically of helping investors select actively managed mutual funds have been suffering tremendously through this environment. And likewise, asset management companies now are finding new and different ways to roll out and repackage their offerings that fit this sort of higher level, more active style, because again, the traditional managers really, consumers have lost interest, and I think advisors have lost interest as well.
Yeah. Okay, that's really interesting, and I think it leads into my next question around moving away from investments, which is I think where a lot of financial planners have typically in the past, built their business and focused on, into the more broader financial planning, if you like, around things like helping clients manage their cash flow better, and also the behaviour that they have around money. I know in your practice you've got those two components of that.
Yep.
What are you seeing in the financial planning space that is making is evolving and making a big difference for your clients?
So a few things. We kind of look at the advisor space overall. I mean, we're sort of seeing, I guess, a high level, what I kind of call this progression from product-centric world. So, the traditional transactional world, we sell insurance and investment products, to a more relationship-based, heavily assets under management style model. And then sort of the front end that's starting to emerge out of that, which are much more pure, I'll call them pure financial planning businesses that are shedding some or all of the investment management activity altogether and are just focusing entirely on, look, all we do is financial planning, and at best, we'll tell you some funds to buy, but that's not any more material than the comments we also make about how much you spend on your car or what you do with some other things in your cash flow. We haven't seen a huge adoption of that kind of model yet, I think in part because the assets under management business is still pretty effective and pretty lucrative. Margins certainly have gotten squeezed a little bit, but it's certainly appealing. And given how many advisors started historically in the transactional business, there's still a whole lot more leaving transactional just to get to assets under management than there are sort of ones leaving on the other end. That being said, I do think we're starting to see some of the forces of kind of commoditization start pushing through. Just being an asset gatherer is not terribly differentiated when everybody else is doing a whole bunch of asset gathering as well. And if the only way you can distinguish yourself is we've got a neater, better, fancier, smarter, more brilliant investment process or investment manager, and that's all you hang your hat on, the only clients you're going to attract are the ones who are really excited by that story, and those are the ones who are probably not going to stick around very long. As soon as the story doesn't work out, they're going to get sold on some other story and they're going to move on to the next thing. And so it's sort of what we call hot money, which means that they come in quickly but they leave quickly. So we see a lot of practices that are kind of doing this hybridization version that says, look, we're going to make the business model predominantly assets under management because it works very well, certainly for the subset of people who have assets. But we're going to make sure that we don't just do investment management because we don't want to be commoditized in that bucket. We're going to do all this other financial planning work to try to add value beyond that, and just let investments might be how we charge, but it's only a small portion of what we do. And that's sort of the piece that's really, I think, emerging and becoming most popular here. You see firms calling themselves financial planners. You see themselves calling themselves wealth managers. It's sort of one of the new labels for that phenomenon, and they'll really cover virtually anything under sort of the CFP body of knowledge. So that may be helping clients with their ongoing tax planning issues, that may be helping clients with their estate planning issues, that may mean reviewing all of their life and health and disability products, that may mean giving them some guidance on their property and casualty products, that may mean talking to them about budgeting and cash flow, that may mean helping them out just figuring out all these retirement questions that we were talking about earlier of, how much should I spend and when should I retire? And, like you guys, we also have some social programs, our version of superannuation funds, which is called our Social Security program, which does not have a lump sum option the way that yours does, but does have some timing decisions about you can choose it as early as 62 or as late as 70, and there are all these adjustments that happen if you start early or late, so that becomes an important decision piece of the process. So we see a lot of firms try to build around that, and it's sort of the anti-commoditization, particularly as we see now even some online investment platforms cropping up saying, hey, we can build you really nice fancy portfolios with all the modern tools and technology and continuous monitoring and tax benefits and all this other stuff, and we can do it with a computer and an algorithm and charge you 25 basis points or less. So if you're an advisor charging 1% a year and all you do is basically that, you're in serious trouble. So we see the advisors sort of pushing in that advice end as a way to make sure that they've got some deeper relationship, some deeper connection, and just more of a value add than just bringing an investment solution to the table.
Yeah, I think that's a great point. Really similar things that we're seeing over here at the moment.
Yeah, it's striking to me sort of the trend to it. So on the one end, and I mean no disrespect to the folks there, but watching the evolution, I kind of feel like the U.S. was sort of ahead of Australia in some of this evolution, this move away from product and transaction based and in the direction of these assets under management models. I mean, this has been rising in popularity for 15 years here in the U.S. Our firm was started on this model 20 years ago, which is part of how with 20 years worth of growth, we've got $1.3 billion under management. We've been at it for a while. But the flip side is, now those tables have turned around entirely. We're still getting there, but we're getting there entirely voluntarily, one firm at a time. You've had, by giant regulatory fiat, you've legislated everybody into this business model over the span of 12 months. So the parallels to me are kind of fascinating around how that has been playing out here in the U.S. as a slow transition versus how it's going to play out there in Australia, where regulators have pushed the whole industry there a whole lot faster, and it just it impacts the landscape, I think, dramatically. I'm sure advisors there are still very much feeling that and the ripples from it.
Yeah, there's no doubt. There's a lot of firms, and I think who are already down that path, who haven't been so affected. But over the coming year or so, I think we'll see a lot of firms here that probably weren't already down that path that'll start to feel that a lot more and make a choice of whether it's still the right thing for them to do, because it is a big change. Finally, Michael, I wanted to get your thoughts on any emerging trends or ideas that are coming into the planning space, be it solutions for clients or technology, social media that you're seeing.
So a few things. I'll kind of pick one on either end. On the one end, in terms of clients and solutions for clients, I think we're seeing this ever-growing awareness of what the research calls behavioral finance, and what in essence I'd call all the behavioral issues we have to deal with clients above and beyond just knowing the technically correct answer. How do you actually get someone to change their behavior to do it and to be better in their financial lives and be better in their personal lives because of the advice that you brought them? And I think we're still in the very, very early stages of that, but we're seeing kind of this growing acknowledgement to it, and it's starting to impact everything from how we might explain investments, the software we use to communicate investments and financial planning. We're seeing financial planning become more interactive. Some of that is the tools and technology that allow us to do it, but what we see from the behavioral end is, when you get to be hands-on to your plan, you're more engaged to it. So I kind of liken it to buying an automobile, buying a car. Nobody's really happy just buying a car because they looked it up online, or they went to a car dealership and the car dealer said, well, I've asked you a lot of questions for the past hour and I figured out here's the right car for you, now sign here. That's not how we buy a car. We want to test drive it. We want to go out there. We want to feel it. We want to kick the tires. We want to, drive around it a little and get comfortable with it. We may ultimately come to the exact same decision, say the car salesman was right, but we need to be part of the decision and own it in order to really buy into it. And, certainly anyone who's managed any staff has seen the same thing. You can tell your staff what to do, but they don't quite have the same level of buy-in as when they're part of creating the solution. And, certainly anyone with teenagers kind of witnessed the same thing. So, we see some of that in clients, in this growing acknowledgement that when you make the planning process more engaging and more interactive to them, and it's less like sitting across from the expert who just tells you things and more like you're engaged with the expert crafting this thing that you'll have buy-in to because you built it, clients implement more and they follow through more and they actually do more of their financial plan, and you see more success. And of course, in the long run, that leads to happier clients, wealthier clients, clients who refer more, a more growing business, and all of those other positives. So I think we see a lot coming in that direction of, how do we really do this in a manner that behaviorally helps clients do what they need to do and make the changes they need to change. The other end that I'd say overall is from sort of the technology and marketing end. I think we're still in the early innings of social media and figuring out how social media plays out. It's certainly, I think it's an incredibly exciting space. It's absolutely one I've kind of engaged in part because I saw it with what early on was some curiosity and then with some early successes that said, all right, I can see, something's going to come of this. This is worth exploring further. Including, how we made this connection. We made this connection through social media. This is how it came about. And it's these kinds of connections that get made where I look back at all these connections and introductions and relationships that have been built, and many of those have turned into clients, business opportunities, referrals, and all sorts of other things that have happened. And again, that's kind of the point. Now, part of the reason why I see social media as such a positive here in the U.S. is, frankly, our advisory space has gotten so big and so saturated, and we have so many CFPs now. We're going to cross the line on 70,000 CFP certificates here in the U.S. Soon, and about 300,000 people who call themselves financial advisors. So it's got to be a very crowded space. And there was a point about 10 years ago where just saying you were CFP certificate and doing financial planning was pretty differentiated compared to stockbrokers and insurance agents that were running businesses from 10 and 20 years ago. Now, increasingly, advisors go out there and say, I do all this comprehensive financial planning and wealth management, and they're competing for clients with 3 other advisors who say the exact same thing. And just the fact that you do financial planning is not differentiated here anymore. You need something that goes beyond that and goes deeper than that. The opportunity then is you develop more of a niche. You develop an area where you have greater focus, where you can say, look, lots of people can do a financial plan for a heart surgeon, but I specialize in heart surgeons, or I specialize in eye doctors, or I specialize in executives from this particular company. Yes, anybody can analyze your executive benefits, but I've done it for 17 other executives in your firm, and I know how every detail works like the back of my hand. And suddenly you can truly become the best expert at what you do. Nobody can be an expert. Nobody can really be the best at being a generalist that does everything for everyone. You can be the best at some specialization in particular. Now, classically, the fear about specializing was you're going to make your, if it's hard enough getting new clients as is, it seems like it's going to be harder when you make the pool narrower. In a world of social media and sort of this online digital marketing, though, that kind of flips around. You can pick some specialty that only has 100 people in the world. You can work with those 100 people anywhere in the world, and they can find you online, and you can do meetings with Google Hangouts like we're doing here. You can make those connections. You can actually do that. So as the geography barriers come down from technology, the potential to work with clients anywhere grows. The potential to reach them through digital marketing and content grows, and suddenly social media becomes viable. It's sort of the means to get to that. So like just going out there and saying I'm on Twitter and Facebook doesn't bring you anything, but to establish yourself as a leading expert in a particular type of clients so that you can find them, and more importantly they can find you, is a strategy that works. Here in the US, that's becoming necessary because you have to figure out how to differentiate yourself. I'm wondering, sort of watching it from this side of the ocean, I'm wondering if we're going to see the same phenomenon occur very quickly in Australia, because again, by your regulatory change, by regulatory fiat, all of you are suddenly running business models that are remarkably similar to each other. and you're going to have to find new ways to differentiate yourselves, and then you're going to have to find new ways to market yourselves in whatever your new differentiated focused fashion is. And suddenly things like social media and blogging and sort of the broad category of inbound marketing quickly comes to the fore as an effective and scalable means to do that, especially for small businesses that don't have a lot of capital to go do advertising and billboards and commercials and all those other things that large financial services companies do.
I think that's fascinating, and here in Australia it's definitely early days as well for social media. I think we've got some advisors who are taking that on. I love the fact that we can easily tap into seeing what's happening with some advisors over in the States there, and I agree that the ability to make this connection and have this conversation coming through there is just something that wasn't available not long ago at all. So I'll leave it there. Thank you very much for your insight there, Michael. I appreciate your time this morning, and look forward to catching up again. Thanks.
Looking forward to it. Thank you.